Hey traders, Ryan from blockstocks.com. In this video, we're going to talk about the various ways that we can establish levels of support and resistance. This is important to know because price will often reverse at these levels or stall before continuing their movement. On this chart, let's look at the first couple of ways that we can do that. One way is this custom indicator called Voodoo lines, and what they are historical levels of support and resistance. The green line is called a tree line, the red line is a fire line, and all the other ones here are called mogul lines, and then the white lines are snow lines. If there are colored lines such as the green line, white line, and the red line, they are more major levels of support or resistance. You can see here that the price tends to respect some of these levels here, and they help to determine areas where price might decide to stall out and then reverse before resuming a different trend. A different way that we can determine levels of support and resistance is with something called Fibonacci retracement. And the way we do that is we'll have to trace a previous high to a previous low to determine upward levels of resistance. So in this example for BlackBerry, we're going to go down here to our tools and choose this one here, Fibonacci retracements. Then we're going to click the high of the wick and trace down to one of the lows here. And then it gives us a proportion here of various levels that price tends to respect. And so the first level here is $13, then we've got $14 and $15. Before we move on to the options chain to see another way to determine levels of support and resistance, let's look here at other ways to determine those levels. Sometimes these price action can respect different levels such as Bollinger bands, Keltner channel, the mean of those indicators. This is the mean of the Bollinger band. And they can also respect moving averages. We've got here in blue the 8-period moving average, and in gold the 21 moving average. So it's important to have an awareness of those levels so that we know where to enter and exit trades. Going to show you the options chain and maybe a different way that we can determine levels of support and resistance. One way we can do it is to just look at where all the volume is. So for example, on this BlackBerry trade here, let me just finish this here. We can see that a lot of the volume is at $15. We got some here at 11.5, but most of it is here at $15. So in a way, that's a level of resistance for this particular ticker on the upside. On the downside, most of that volume is occurring at $9, so that could be considered a level of support. A different way that you can do it is use the implied volatility of that option expiration and add or subtract that to the market price. So if we bring up our calculator, and we're going to use the market price of 10.69, and we add this option's implied volatility of 0.976, that gives us an upward range of about $11 to $12. Now we also have a market maker move right in here that is an additional amount of implied volatility that market makers are pricing into these options. So let's go ahead and add that in, plus 0.112. So the upward trading range is closer to $12. So that would be the first level of resistance that I would consider. So in order to take a trade on, say, this ticker, and just as an example, you could trade in the money, something like I would choose a delta close to 70, maybe $10. And when I start to look at closer which one here to take, if I wanted to do an in the money trade, I'd like it to be as close to delta 70, but I also need the volume to be there. So here we're looking at delta 70 with only 74 options traded. That could make it difficult to exit this trade. So I might want to go up here to the $10.50. It's a delta 60, but the volume's higher, might make it easier to exit this trade. Another way we could trade this is at the money, right here at $11. And you can see here that we have quite a lot of open interest and volume, and we have a very tight spread here at 29 cents per contract. So that's a good trade there. Or we could trade out of the money, any number of these options, but as we had to determine that for this particular expiration, that the upward trading range is around $12. So it is possible that the ticker can overshoot that level, but it might be safer to take this trade here. We've got a lot of volume and open interest here, and the spread is very tight at 0.115, or basically 12 cents per contract. So you could buy bunches of these contracts for very cheap, and there would be maybe a higher chance of it going from 10.7 to $12, a higher chance of it doing that than going from 10.7 to say $15. You can buy these options way out here, but as we approach expiration, these types of options have a very high likelihood of going to zero because of time decay. So if you're going to trade way out here out of the money, you really need to be watching the price chart basically all day long, because you have to take profits on the first burst of momentum. Otherwise, these will decay very quickly. So in my opinion, just in terms of my own trading philosophy, I like trading in the money at delta 70 or something close to that, because they retain value with intrinsic value, but also I don't mind trading at the money all the way up to some level of resistance, for example, the $12 in our example. Hope you enjoy this video. Look out for some of my other videos on trade psychology.